Hey, everybody. Welcome back to the gallery. Very cool episode today. For those of you who checked it out, last week we had a really awesome deep dive on the corporate innovation model, which is where studios can work with corporations. A lot of great follow-ups came from that episode. If you haven't watched it, definitely check it out. So today, really excited to sit down with Ben from Highline Beta. Ben, great to have you here. We're going to dig in way deeper on the corporate model for studios. Ben, I mean, I could try to fill in the blanks and talk all about your studio, but I'll really let you do it. Tell us about yourself and tell us about Highline Beta and where you guys are at today and how you got there.
Sure. Thanks for having me, Jake. I appreciate it. So I started Highline Beta 7 years ago with a co-founder, Marcus Daniels. My background's in the tech space. I started my first company in 96. And I've built a couple of startups. I've worked for a couple of startups. I've been an angel investor. I worked for a startup that was acquired by Salesforce, and I spent a couple of years there. So all software, B2B, B2C. And then 7 years ago, got together with my co-founder, and we were looking at a couple of things, a couple of key things for Highline Beta. One is we love investing at the earliest stage possible. We said, great, but we didn't want to be just investors. Because we also enjoy building stuff and getting our hands dirty. We said, well, how do you combine investing at that earliest stage with building? We said, the studio model. And both of us had experience running accelerator programs. I had run previously something called Year One Labs, which was actually, this is 2010, was probably a venture studio, but we didn't call it that at the time. And so we had all this mixed experience. We said, well, let's invest, let's build. That's a venture studio, but we also want to do it with corporate partners. And there's a couple of reasons for that. But in our own portfolios, we had seen early stage companies really start to accelerate when they got that first big customer, that first big partner for distribution, for revenue, whatever the case may be. So we were trying to bring those three ingredients together. Investing at the earliest stage, getting our hands dirty in building, and corporate partners. And that's how we launched Highline Beta 7 years ago.
Got it. And so what is your typical balance or mix between building startups with corporate partners and then just building them yourselves and investing in them yourselves?
We do both. We've found, and this shouldn't be a terrible surprise, that spinning companies out, and that's a lot of what we're going to talk about today with corporates, is not the simplest thing to do. And that's completely fair. It probably shouldn't be the simplest thing to do. And so we've balanced it. We've built and launched 9 companies so far. We've also made 9. And so we have a holding company, an incorporated entity, and we have a venture capital fund. So we have both structures. We've built and launched 9 companies. And we've also done 9 separate investments in early stage startups. And so we've done a few of them with corporate partners that were there on day zero. We've done a couple of them where corporate partners come in a little bit later in the process. So we start the process off, do some validation work, bring in a founder, then spin it out and incorporate the company, then look for corporate connectivity because we still believe in the thesis of getting little companies and big companies working together. So it's been a balance for us, and we'll continue to do both, sort of incubate or instigate our own, and also work with corporates to spin companies out from there.
Yeah. Okay. So, before we got on, you mentioned that there's just a huge difference between the process of building a company before it's incorporated, pre-incorporation versus post-incorporation. When a corporate is involved, corporate partner is involved.
Yes.
I mean, let's just dive right in,
Sure.
to the deep end on this one.
Yeah.
Talk about this. What's the deal with that general topic?
Yeah, so I think the way that we've done this work with corporate partners is pre-incorporation, you're doing work on behalf of a corporate partner. So it's almost more a service engagement in a way. And in fact, we run an innovation services business that works with corporate partners on projects. Sometimes those lead to building ventures. Sometimes those ventures get spun out, but sometimes those ventures stay in-house also, and they're completely owned by a corporate partner. So it's almost as if pre-incorporation, it's really a service project that you're doing with a corporate partner. They tend to own the IP. And so if a venture doesn't get spun out, they hold that IP, and that's more of a consulting agency style model. You're working very closely with the corporate partner to validate the opportunity. You're looking for at least competitive, if not unfair advantage that comes from doing the work with the corporate partner. They've got the customers, they have the data, they have distribution. There's something that they're bringing meaningfully to the table, of course. But again, it's more of a project. The minute you decide to incorporate the company, all of that has to change because now you're creating a net new entity, and that entity really does live on the outside. Now, we have worked with some corporate partners that actually do create separate entities, but they're wholly owned. And so that's different. But when we go to spin it out, bring in a founder, create a net new company, new cap table, investment dollars now go into that thing. Highline Beta will now invest in that company. The corporate might also invest, but that's open for discussion. It is a truly independent company. So there's this very big difference between pre-incorporation, more of a project. Okay, we're actually going to go do this. And the way we typically do that work is we're not always doing work with a corporate partner where the only answer is you must spin out a company. So again, we remain agnostic to the answer. So sometimes we're doing work on an opportunity, a problem space, and our answer is don't build anything. We found a great startup. You should just buy that startup right now. We've found a real problem. There's a real opportunity. It strategically makes sense for you as a big company to go into that space or tackle that opportunity or problem. But there's a startup, just partner with them. The answer isn't always go build a net new company. But when it is, then you're incorporating, and it really does change the relationship between all the parties that are involved at that point.
Yep. I mean, it's almost at that point you're an innovation consultant who can also then build ventures where most other innovation consultants can't.
That's right. It's a continuum for us, which is we're not going in and saying, again, the only thing we're going to do or push you to do is spin companies out, because I don't believe that spinning out a company is the answer to every problem/opportunity. It is a legitimate tool in the toolbox, and that's really important.
So,
but it is just one of the tools in the toolbox, not the only one.
Yeah, let's talk a bit about equity for a second, because I think that's like the elephant in the room in a lot of these conversations and a lot of people's minds. Is like, all right, now when you build a typical startup, you've got a few parties that need equity. There's the co-founders, and there's the investors, and then there's the stock option pool for future employees. Well, then you throw a corporate into the mix, and it like messes everything up. First off, I mean, high level, like when you look at starting a new startup from scratch with a new corporate, what's the typical equity split? And like, when do all those conversations take place, and when do all those shares get distributed? And then if there's different nuance of like, okay, we're building something that a corporate comes in later, or the corporate already had something and we come in later. Like, can you walk us through the different scenarios and outcomes that you've seen and worked with a lot on how equity plays out?
For sure. So I'll walk through the scenario, working with a corporate, exploring a space, validating something, then make the decision to spin it out with them as a partner. And in that scenario, the equity, not surprisingly, does range. We've learned that you have to negotiate that equity and what the structure of that new entity is going to look like before you start. That's not surprisingly, that's really important. But in our early days, as we were sort of flying a little bit by the seat of our pants, as founders are wont to do, sometimes we were like, let's just get in there, see what's going on, create value, and then we'll sort it out. But of course, the corporate
never works that way.
It doesn't, the corporate is the one putting all the resources, a lot of the resources in. And if you do it that way, you'll inevitably get to the end and say, but wait a second, the corporate, we've foot the bill. We're taking on what is perceived as a lot of risk for them. They're almost always going to feel a little bit uncomfortable about it. Sure, Highline Beta has done a lot of the work, created a lot of the value, but we probably need to own 80% of this thing now, right? And you're like, no. Then it's not a real startup. It's certainly not a venture profile startup. Now, that's another part to that equation. Not every startup that comes out of a studio model maybe has to be venture profile. But if that is the goal, venture profile companies, and in fact, one of the reasons you're spinning it out is because you don't want to take on as a corporate all of the risk. So you're like, great, I want other people to fund this thing. It's like fantastic, but then there's got to be the cap table has to make sense. So generally speaking, what we see is corporates looking for between 10 and 30%. And 10% is on the lower end. In some cases, that has a lot to do with regulation, where if they own more than 10%, it starts to trigger all kinds of regulatory issues, which they don't really want to deal with. At that point, they might as well just own 100% of it and deal with the regulations.
Sure.
30% on the higher end, because then when you consider what Highline Beta is also going to be taking, which in our model has varied over time, but as we work to standardize it is about 18%. So I usually say like sub 20 is where we sit. But then let's say it's 30 for a corporate. Let's say it's 15 for Highline Beta, or 15 to 20. Well, now you're at 50% owned by the investors, basically, and the founders getting, call it 40%, and the ESOP, the stock option plan, is about 10%. Now, I say founder, right? But it could be multiple founders, but they own 40%. So that cap table gets a little tricky for downstream investors. Future investors will look at that cap table and say, not sure about that. Again, the dependency there is, well, how far did we actually take that company? But if we've just taken it to launch and their first customer is that one corporate and they're really still a seed stage startup, that 30, 20, 50, that's a little tricky for some investors, not all, but for some investors to really feel like that's a venture profile kind of startup.
I see. Just out of curiosity, how did you land on these learnings in these situations? Was it like, we just got in there and tried stuff for 5 years with corporates and this is where we ended up? Or was it more like, well, we talked to 6 other, we studied all the other corporate partners, studio partners out there, and this is what they were all basically doing? Or
both?
Was it more like we kind of just found our lane here?
No, we did both. But what's interesting is, and of course there are studios that are older than 7 years, of course.
Yeah.
But it was still pretty early days.
Totally. I remember I got into studio world 7 years ago.
Right.
We counted 80 in the world.
Right.
And like 60 of them were willing to talk to each other.
Right.
Today there's, fill in the blank. Everyone has their own number of how many there are today, but that was the TAM. The TAM was 80.
Yeah,
it was not
totally.
big.
Exactly. And so there wasn't a lot of information. And I think a lot of the studios were, and maybe still are, although I was going to say competitive, but competition in studio land is not that significant. But nevertheless, there wasn't a ton of information. There wasn't a ton of network or community, as we're seeing that start to grow and scale now, where people are sharing this data, sharing the information. Studios have built 5, 10, 15, 20, 30, 40, 50 companies, and they've got they've iterated through it. So we did a bunch of research, collected what we could, learned what we could, and also then just iterated ourselves, and also figured out, well, Marcus and I were both investors beforehand, startup investors. And so, quite tapped into the investor community. So looking at what did we think made sense for venture profile companies, but a lot of learning, a lot of iteration. And I will say, we tried early on, let's get a standard deal. This is what the deal looks like. End of story. That's the deal. And it doesn't work. Every corporate's going to be a little bit different. They're going to be a little further or less far along in their own innovation journeys. And so we haven't been able to totally standardize that model, which I think is okay. And I suspect most venture studios are similar in that way. They have a typical model they start with, but then everything ends up getting negotiated just a little bit. And that's part of just the process of iteration.
Totally. I have a question. It's a 2-part question, but I'm curious if we can layer both answers together, meaning it's a double layered question. There are stages, right? Stages like, let's go explore with the corporate what we're going to do together. And then it's like, all right, we signed the deal. Now we're in the validation stage or whatever. Can you walk us through what those stages are at a high level? But the next level down is, who is in the room at each of those stages? Who needs to be in the room? And I feel like what we know, it could very easily become a too many cooks in the kitchen scenario at different stages. So who also should not be in the room at each of these stages?
Yeah, great question. So we go through a model that's going to look similar to most studio models, I would say, and most sort of innovation framework models as well. We have sort of two stages before we would go and decide whether it's worth creating a company. We call them discovery and venture validation. Discovery is, the starting point is often quite broad. A corporate partner wants to explore a new market or sees a trend emerging and wants to go figure that thing out, but needs help doing it. They don't maybe have the capabilities. Often they're just too busy doing sort of core business work in-house. And so they say, look, can we bring in Highline Beta to help us go explore a certain thing? So it usually starts pretty high level. And then we're doing, as you would expect, customer research, customer validation, primary, secondary research, testing value propositions in market, all of those sort of tactical things to get to the end of the discovery process. For us, that typically takes about 3 months. And the goal there is really to validate the problem, is a simple way of thinking about it. Is there a real problem here worth solving? And we're also starting to look at things like market size, and we're starting to look at what right does that corporate have to play in that space? And then venture validation is just an extension of that, which is really, again, typically about 3 months. We're not building the MVP yet, the minimum viable product, but we're starting to bring prototypes and concepts to market. We're, again, further evaluation of market and potential to try to validate a solution or a proxy of the solution. Then we would incorporate the company and start sort of our 0 to 1 build. In that pre-incorporation phase, we're usually working, of course, very closely with people on the corporate side. It's usually somebody who's involved on the innovation team. We're usually reporting back to the C-level executives, maybe the CEO, maybe there's a chief innovation officer. And usually there's go, no go stage gating that's happening there. Do they believe this is worth pursuing? And we like to have a seat at that table to have the conviction. And so our conviction says, hey, if this is a real company that we're going to spin out, we're trying to do this to put our own money in. So trust us as that sort of external third party that's willing to take risk once we incorporate. Yep. So, we have a seat at that table as well. And then there's usually that kind of pitch deck almost presentation that you're bringing back to an executive team. And then you want all of the stakeholders inside of the corporate involved in that, from the C-level to the people who might actually work with this startup when the startup gets built. So you think, if this corporate is a customer, who is the actual buyer of the software? We need to involve in that process at that early stage. When the company gets incorporated, it's a little bit different. And it's really, we need less cooks in the kitchen there, because in our mind, that company is now run and led by a founder who should have the bulk of the equity and should actually have voting control over the startup. So in that scenario, there's a very good chance somebody from the corporate partner is on the board. Highline Beta sits on the board, but the founder still controls the company. And again, now you still have stakeholders. Again, the corporate might be the customer. So the founder of the startup has to work with those folks on the inside, but they don't have a say on what happens to the startup. So if that startup decides to pivot, that startup can pivot, and that can happen, right? So it's really corporate control pre-incorporation, if you want to think about it that way, startup control post-incorporation, and sort of that's a quick summary of how it would work.
Yep. So when you're in the early stage of even like in exploration, what was the word you used for it? Like the first stage?
Discovery. We call it discovery.
Discovery. Okay, great. So you're in the discovery phase. How often are you finding yourself being like, you leave the meeting and you're with your partners and you're like, yeah, this is not going to be a good partner for us. And what indicates that feeling? Why do you sometimes feel that?
Well, I think, again, we can certainly figure out if a corporate is ready for the conversation around the spin out model or not. If not, that's okay, because again, in Highline Beta's business model, we do run an innovation consulting business. And so we might, get in there and say, okay, they're not quite ready. They like the idea of spinning things out, but really they're probably not ready for that. So everything we're going to work on is likely going to lead to an internal venture being built, almost like a spin in, if you want to think about it that way. And again,
Spin in. Interesting. Okay.
it's a way of thinking about this. Hey, we're here to build ventures, but we're going to get to a stage where we're going to say, do you want to really control this thing and run it? Or do you want to set it free and see what happens? Many folks will say, no, we actually do want to control it. We like the idea of spin out. We like the optionality of that. We're not quite ready for that. And so, we can figure that out pretty quickly. But again, in our model, that's okay, because we're still building great networks. We're still learning insights. There's still a lot of value that comes out of that work, even if the bulk of ventures end up being staying in-house and being 100% owned by a corporate, and as a result, not investable by Highline Beta.
Yep. You ever find yourself in a scenario where it's actually the opposite, where like you get in with a corporate, you start doing some research and validation, maybe even a little bit of building, then you realize this is not a good fit for the corporate to be a part of, but we should have this internally at the studio ourselves, and you just kind of keep it to yourselves?
Never keep it to ourselves. Never keep it to ourselves, okay. Right? Because we're working on behalf of the corporate. But what absolutely does happen is, because through that discovery and venture validation process, we're usually chasing multiple things at the same time. It's rare that you're chasing one very narrow specific thing, because you always run the risk of invalidating it and then you're sort of restarting. And so it tends to be broader areas that you're exploring with the goal of finding a handful of opportunities to pursue. So what inevitably happens is some of those opportunities are better suited for the corporate to run with on their own. And some of them are 100% better to actually spin out. And the delineation there's a few sort of criteria for us. One is it closer to their core business or further from their core business? If it's closer to the core business, they probably will want to own it and run it, and they have the capabilities to do so. If it's further from the core, that's going to be perceived as more risky. They'll probably feel like they don't have the resources or capabilities to execute. So that's one. Regulatory risk, compliance risk also can play a role in regulated industries, where they say, well, look, that's an awesome idea. We totally see the potential of that thing, but we really don't want to own it, because it's just going to be uncomfortable for us from a regulatory or compliance or security arena. And so we say, great, then those things we should probably spin out. So there's a few criteria like that where you say, should they keep this thing? Is that the best way of realizing the potential? Or should we actually find a founder and go create a new company? And again, we often through our process are finding opportunities that are suited for one or the other.
Got it. Okay. Let's talk. I mean, we mentioned the board a little bit before. I'd love to talk about the board. So you've got a board walk us through, like, when does the board form? Who's represented on it, and how does that shift over time or evolve over time?
Yeah, so the board has to be structured when the company is incorporated. Founder sits on the board. If there's two founders, both founders might sit on the board, but often it's just one founder that sits on the board. One of myself or Marcus will also sit on the board. And then if we're working with a corporate partner and spinning out a company, then somebody from the corporate partner may sit on the board as well. And I say may because, again, some companies get pretty twitchy about their employees having fiduciary responsibility for other stuff. Like, being a board member it's a thing. It's not just like, cool, I'm sitting on a board for fun. You have a fiduciary responsibility to this company. It's a significant responsibility, albeit the company is 5 days old, so it's not like there's much to do. But it comes with risk also. You have directors and officers insurance on day one, because you're incurring a risk when you create new companies. So, but typically it's founder, one of myself or Marcus, and then the corporate partner also sits on the board. We will usually get off the board at Series A. So our goal is not to stay on the board forever, but when new investors come in with bigger checks, we will usually say, look, we're cool giving up our seat at that point. We don't have to, because in part because you need new board members coming in part because we can't sit on that many boards.
Sure.
And I think with the corporate, it's kind of the same thing. It will depend on the relationship with the corporate partner at that stage. So, if they've got a CVC, a venture capital arm, and they're continuing to invest, they might want to then sit on the board as a result, or maybe move to board observer. And because I think typically the corporates don't really want to sit on the board for that long, because again, they're incurring not a lot, but there is some risk there, and corporates are thinking smartly about those things. So Series A, there's often this shift in the board structure.
Very interesting you bring that up. So let's tackle this for a little bit. For anyone listening, for some context, this get out at Series A topic has been a very nuanced, very tricky scenario for studios over the years. It still is. So this is worth paying attention to. Let's really hack on this one. I've heard many, many, many times from VCs especially, and then the number two is from entrepreneurs. And the founders are the most important stakeholder here for studios, typically.
Agreed.
VCs are very important because they often help make this thing get to an exit, not just get off the ground. And their most common argument as to why they don't love studios being involved or at all is, they provide all this value early on and then they don't provide any value after Series A. So why should they have such a huge chunk on the cap table beyond the Series A stage, which is, right, one might say, sure, the hardest, most risky stage is seed to Series A, and the risk goes down at every round after that. But that doesn't mean it gets easier at every round after that. Some would argue it gets harder at every round after that. So when you say you get off the board at Series A, does that mean you're completely out and that's where we basically book our return? Or are you just getting off the board and you're going to somehow maintain ownership throughout the full life cycle of the company to ride through the whole waterfall?
Yeah. No, good question. So we getting off the board does not mean we're selling our stake in the business. It just means we're no longer involved in the governance, the official governance of the business. I'd like to believe, because we created that company with a founder actually from day zero, which is, most their founders don't have necessarily a ton of people supporting them on day zero, that we are still considered trusted advisors and will support that founder. And I think your point, the founder is the most important stakeholder, is true. So, I'd like to believe, founder keeps going A, B, C, that they could call us at any time and we will do everything we can to support that person and help the business to the extent that we can. But I think that our role changes more to consigliere and mentor at that stage than it does we're in the weeds of the business, helping them execute strategy. Now, in terms of exiting our position at Series A, we're open to that. We've done it in some cases. In other cases, we haven't. There's a lot of variables that go into that. One is there even an option to get out? It has to be given to all the early investors, so you have to think about that. Is it an option to sell half but keep half? So there's a whole bunch of decision criteria. What's the valuation at that stage? What's the return at that stage? So there's a whole bunch of thinking that has to go into that if that opportunity comes up. And I think for studios, it is a logical step in the process because they built the company at the lowest valuation possible. The Series A should be and is a marked up valuation. So you're just looking at that and saying, if we have an opportunity to get out strategically, should we? Do we get out all of it? Do we get out part of it? What's being made available to us? So that's definitely part of the thinking process.
Yeah, I'll share a bit of an anecdote. It's almost adjacent, but I think it is quite relevant here, which is, and I'd love your opinion on this because we haven't talked about it yet, but during the bull run, which was 2020 to 2022, let's essentially call it that, roughly 2-year span, saw huge growth in studios. And the first thing they'd all go do is try to raise money from LPs. And the makeup of LPs were always different. Some had family offices, some were going to VCs, some were going to like friends and family, some were going to corporate partners, some were actually going the institutional route. It ran the gamut, but that's beside the point. What they all recognized, though, was that, well, these LPs had lots of other investment opportunities, not just, they weren't competing to raise money from LPs with other studios. They were competing with Bitcoin and real estate and all the other asset classes that were absolutely crushing it during the bull run. So yeah, you put yourself in the shoes of an LP who's like, well, I've never heard of a startup studio. I don't understand your structure. You don't do 2 and 20 like all the other venture capital funds out there that I'm in. And I've got 50 other asset classes that are looking at higher IRR in less time. So why should I back a studio, let alone your studio? And so all these GPs, studio GPs, were pitching this like, if we get in at zero, day zero, and we ride this thing to IPO, we'll make billions and billions of dollars. It'll be a massive ROI. But I think what they were missing was how long it's going to take to get to that IPO. 5, 7, sometimes even 10 years. And so you couple that with all the other challenges, it was really hard for them to raise their fund. Most of them didn't raise a fund, so they end up never launching their studio. So that's the backstory. The suggestion that I was making to a lot of studios was, hey, look, you just got to get to the table. You got to prove that you can produce a meaningful IRR. That's what they're looking at. And by the way, IRR is a time-based multiple. So if you can build a strategy, at least in like your proof of concept fund or fund one, and say, we're going to spin up ventures, we're going to get 10 or 5 or even 3 to a very nice markup Series A in less than 18 months. And it's almost like the ship and flip model, like you're flipping houses, like build a few startups, flip them, get out early. Now, if you start something and you raise a, $3 million proof of concept fund and you go mark up a startup to 30 million valuation, you add a third of it, and then you sold that and you walked away with 10 million bucks, you just 3x your fund more in like 18 months. That's an incredible IRR. So the whole theme was like, well, make your strategy to get out actually at an earlier stage versus ride this thing for many, many years. Like you just got to then go back to the LPs and say, look at our, 300x IRR, 300% IRR in 18 months. Do you want to get in on our now real fund too? That's going to be $100 million raise. And there were a few studios that I think went after that. I think more though, like everyone's so, I don't know, glassy eyed almost about this, like we ride it to IPO because that's where the big unicorn stories come from. But like, that's just almost impossible compared to something that's actually pretty doable. How do you feel about all that?
Yeah. Yeah. So I think the idea that studios can drive early returns because they do get in at a low valuation. They tend to take a bigger chunk of equity for the value, the sweat that they're putting in beyond just the cash that they're putting in, affords them the opportunity to get out early and generate quicker returns. There's nothing has really sped up the IPO, the unicorn process. There are obviously some companies that, scaled massively within a couple of years. But again, when you look at it, it's usually a 7 to 10 year journey, like any VC fund. And so I'm a proponent of if you can get out early and generate quick returns and demonstrate your ability to do so, you should definitely look at that option. I think what's important there to think about for a studio is how do you manufacture those early exits? You can't just assume they're magically going to happen. So now you have to start to think about, well, what kind of companies am I building? In what verticals or industries? Who are the acquirers that might be interested in this? Which, by the way, does go back to where we started the conversation around corporate partners, because I do think there's a model, although we haven't done it yet. So admittedly, we haven't done this, where you could spin a company out with a corporate and the corporate could reacquire it. We've had lots of conversations about that and explored it a few times. But I'm a fan of that. I think studios and VC, we all talk about the power law. One of them pays back for all the other stuff. And I don't know that studios are going to radically shift that model necessarily, but I do think they, in baseball parlance, will hit more base hits. And if they're smart about it, they'll semi-manufacture those base hits to
Yep.
demonstrate value. Where it gets tricky, and this happens to funds too, and we're seeing it now in the market, bigger funds really struggling, is will studios go from doing what you said, Jake, just build a few companies, which by the way is already super, super hard. And we shouldn't pretend it's like, oh, cool, I'll just do that
Right.
over the
Yeah.
weekend, just hack these and sell them for 30 million bucks. But build a couple and then say, oh, that worked. Now let me go raise more capital and do 10. Oh, now let me go do 50. Well, guess what happens? Now you've got to return $1 billion. And so that's the tricky thing in the model of how do venture studios scale, or do they actually scale? The same way that VCs try to scale by assets under management. Start with a small fund and then get to a big fund and then realize, I've got to return this massive fund. So I think that's part of the challenge that still has to be figured out in studios is how do they actually scale? But I'm all for early exits. And I think there are certain types of really high quality founders, by the way, who are also not opposed to early exits. So sometimes that's the feedback. Oh, no. Any founder that wants an early exit is a crappy founder, which is just 100% nonsense. Not every founder wants to, should go or try to go all the way to IPO. I mean, take a swing, but if it's not there, I know lots of incredibly successful people who have made enormous amounts of money. It depends on your definition of enormous, by exiting early. So
Yep.
it would be silly to ignore that as part of the strategy, but then it has to actually be part of the strategy, not just something you're hoping will happen, because that's
Yeah.
not a strategy.
It's funny. The one of the richest people in the world, I'm blanking on his name, was the co-founder of BlackBerry. He sold early. At happened to be the right time at the top, which is clearly BlackBerry had a big up and then a big
Yes.
quick down. One of the richest people in the world. He's
Yeah.
like worth many, many billions of dollars. Sold early,
Yeah.
but just no one knows about the guy. That's kind of
This
a funny
a lot
aside.
of
So
a lot of it's timing. A lot of it's
yeah,
timing, and again, I think where the corporate model is interesting is, frankly, where the studio model is, I think, interesting is you are trying to put more of the ingredients together at the beginning. That's really what you're doing. You're saying, could I bring in the first customer or the first partner? Can I bring in the right founding team? Do I have a studio that can actually help me build something and get it to market faster and bring in that initial capital? Do they have investor VC downstream relationships that will help me get the next round? Who are the acquirers around the table that we might want to cozy up to in this model? So I think that's the whole premise of the studio, is to bring more of those ingredients, puzzle pieces, whatever analogy you want to use, to the table early on, which then
yeah,
creates optionality as you go forward. Do we go for the home run? Do we go for the base hit? Lots of things are also going to fail. It's not like it's one or the other, but I think that
sure,
optionality is a key component of the venture studio model, which I think is also why it will continue to get more popular with investors who have looked
yeah,
at the VC model and said, there's only kind of one option here, is I need a gigantic exits to return everything. Is there another way of making high risk bets with real returns that isn't quite exactly the same as the VC model?
yep. Um, Curious because I think a lot of people are going to be wondering this, and I know people are wondering this for themselves. But how did you guys capitalize Highline Beta right out of the gates?
Yeah. So a lot of our own money,
Yep,
which I think if you can't bring your own money into the studio, you're going to have a hard time not only building a studio, but raising
it's a
capital.
pay to play game.
It
Pay to
is.
play game.
And every investor will and frankly should ask, and they do this at VC funds as well, how much are you putting in as the GP? Let's say if you have a fund structure. If you don't have a fund structure, it's how much are you putting in to start your Inc. So
Yep,
it was that, and then it was a small amount of capital from angels, really friends, and I don't know if they were any of them were family, but friends. So who believed in the founders, myself and Marcus, were interested and curious about the model, but nobody had any huge experience in the model. But yeah, that was it. It was us and initial capital from angels, basically.
Yeah. I'll ask, I know this is a bit of a loaded question because it's so relative to everybody, but I'm just curious. I think a lot of people are curious, like, especially for the first time, like emerging managers who are going the studio route, a lot of them actually don't know or think to put in their own capital. And then they don't, on top of that, realize that there are actually other ways to like put your own skin in the game without just putting in cash. Like you could defer your fees. There's a lot of other things you could do to show that like you're taking a big risk on this as well financially. But what's almost like if you had to pick a number range, you think that is appropriate for an LP, not to gasp either like, wow, that's way too low or nothing, or like, oh my God, this guy's putting in like way too much money. What's a good range that you think is comfortable for a GP to be putting in of their own capital when they're getting going?
Yeah, I think typically the target that I've seen is about 10% of a fund. So if you're raising a $10 million fund, you're trying to come up with about $1 million. And I think for first time managers or emerging managers, there's going to be that's not a hard and fast rule. There will be flexibility on that, of course. And that's if you're setting up a fund structure with GPs, where you're the GPs and you're getting LPs. If you're setting up more of a holdco operating company, that's different because there's no standard there, but that thing has bills to pay. And so you have to figure out, well, how do you subsidize that, or is there a revenue model out of the gate for your operating company? And there's a bunch of different ways of doing that, but 10% is sort of benchmark, but that's also a pretty high bar, right? That's even on a $10 million fund, it's $1 million. It's a lot of money.
Yep.
So I
I
think
mean,
a
how
lot of
many people have?
yeah, stop.
Yeah, how many people have $1 million to be like, I'm going to go invest this in our next thing, or tell your spouse like, we're not going to buy the house, we're going to do this instead.
Yeah, and what I would say there is, again, that's really if you're trying to build a fund. If you're trying to
Yep.
build an operating company that's job is to build companies, I think you can fund that with much less money, but you still need the people to build stuff. You need the people to support the founders, and people have to get paid. So you have to figure out how to get that thing off the ground with, it depends on your team size and what you want to do there. Is it 500K? Just to get in the game. How long can you go in that model without paying yourself a salary? Because that's how you would not defer. You would just say, I'm not going to pay myself. I'm not putting in $100 to take $100 out. I'm putting in $100 so I can hire a developer or a designer or recruit an FIR, a founder in residence, right? I'm not going to just return the money to myself. So really, if you're building like a holdco operating type company, the way that you put in is by not taking salary. So then you have to figure out what's your runway before you can make that thing self-sustaining or raise the capital that you need into it to give yourself runway.
Yep. Well, let's talk about the future as our last little segment here. What's next for Highline Beta? What's next for Ben? And what do you think is really next for this ecosystem and this industry of venture building, of studios, and how do you guys all fit in?
Yeah. So I think for Highline Beta, it's figuring out how to scale the model is really the next stage for us. We have an operating company and we have a fund. The fund is nearing the completion of its current mandate in terms of net new investments, but that's not going to stop us from building more companies. So then we have to figure out, okay, well, how do we put in sufficient capital into those companies? Is it through the holding company? Then go raise fund two. So for us, it really is thinking about scale and how do we take Highline Beta to the next level. But when I say scale, I don't mean 100xing Highline Beta. I mean 2xing it, 3xing it, right? So because I think studios are more step function models than they are hockey stick models. So, but that's really the future of Highline Beta. There's a few things there that I'm excited about around.
When you say scale, I'm sorry to jump in, but I think some studios, when they say scale, I mean we're going to actually open like new branches. Take like Hexa, for example. They just have like numerous studios they're opening, different offices, different locations. Some are just like, no, we want to actually 3x or 5x the number of startups we're launching per year. And that's what we mean by scale. What does scale mean to you guys?
So scale for us, we're looking at a couple of things. So to your sort of question, we're looking at the idea of vertical studios. I think that's
Okay.
one thing that I think is interesting. And to the question before about the future of the model, I do think it's vertical. Highline Beta is launched as more of a horizontal model. So we've worked in a few different verticals. We have a couple of themes that we're focused on, but we've worked in insurance, financial services, consumer packaged goods. So we're a little bit more horizontally focused. And I think our next step is bringing in new partner level folks and building
Yep.
vertical studios. So, because I think that's part of where the future is. And I think it's another way of scaling. So, scale for us means the number of companies that we are able to build, the amount of dollars we're able to deploy into those companies. And then, we're based in Toronto, Canada, but we do work all over. So most of our corporate partners are actually based in the US. So, but we may look at, call it like planting a flag in specific geographies, but I'm less focused on the geographies and more about the verticals and the number of companies we can create and the dollars that we can deploy. Because
Yep.
again, for a studio, the possibility of, owning X percent and then not maintaining any of that as it goes is okay. But I think a lot of studios are trying to figure out, well, how do I maintain at least some of the ownership stake as this thing goes forward? And maybe I do keep writing it. Maybe I am writing a check at the Series A. Maybe I'm a buyer, not a seller. And I think
Yep.
that's an interesting part of the model as well.
Got it. Okay. Well, Ben, this has been awesome. Very technical, solid deep dive today. How can people reach you should you want them to?
Yeah, please. Anybody. I'm always happy to have people reach out to me. They can find me on LinkedIn. I'm easy to find. There are no other Ben Yoskovitzes on the planet. So I'm an easy person to find on LinkedIn. On Twitter, it's just, at BYOSKO. They can email me. It's ben@highlinebeta.com. And then the last thing I'll say is I do have a newsletter called focusedchaos.co. It's not
Sweet.
Yeah, it's not exclusively about studios, but I've started to write more stuff about studios because I want to share stuff that we've learned, and I also use it as a way of learning from other folks, and that's been pretty interesting. So those are all places that people can find me, and please, I encourage folks to reach out at any time.
Love it. Ben, thank you so much. We'll talk soon.
Awesome, thanks, Jake. Appreciate it.